You're listening to the Financial Source podcast on YouTube.
Welcome to the Financial Source podcast.
It's good to be back.
And we have quite a situation unfolding this morning. It's Friday, January 30th, 2026.
It really feels like the entire macro tone just flipped overnight.
It did. We're seeing three huge shifts all at once. There's this sudden uncertainty around the Federal Reserve chair.
A violent reversal in precious metals. I mean, really violent.
And on top of that, renewed aggressive trade threats.
And what's so critical for you to understand is that this isn't about data. This is pure political risk, straight from Washington. And it's actively repricing the U.S. dollar.
Right, which is tightening financial conditions right before our eyes. So, today we're going to get into how the potential nomination of Kevin Warsh is moving the yield curve.
And why these really crowded trades in gold and silver are unwinding so incredibly fast.
Let's get into it.
Let's.
Okay, we have to start with the Warsh factor. It is absolutely the elephant in the room.
It is. The markets are glued to this because President Trump is expected to announce his pick for the Federal Reserve today.
And the reports are suggesting the administration is leaning very heavily toward Kevin Warsh.
And that single headline is driving everything. We're seeing what some are calling a Warsh trade just rip through the markets.
The U.S. dollar has jumped.
Big time, pushing right toward the top of its range. And risk assets are definitely feeling the pressure.
I want to pause on this because it's a little confusing on the surface. Hasn't Warsh, spoken in favor of rate cuts before?
He has, and that's the billion-dollar question.
Right. Usually the market loves the idea of rate cuts. That's easy money. So why is his name strengthening the dollar and making stocks nervous?
Because the market is looking past the headline rate and at the, let's call it the plumbing of the financial system.
The plumbing. You
Right.
mean liquidity. Balance sheet.
Exactly. Warsh is viewed as a hawk on the balance sheet, a serious hawk. He's very different from Chair Powell in that regard.
So Powell is seen as the guy who keeps the punch bowl full.
Right. He ensures there's plenty of liquidity. The market sees Warsh as the guy who's going to come in, turn on the lights, and say the party's over.
He's skeptical of this endless liquidity idea.
You're very skeptical. So even if he cuts the interest rate, the market is terrified that he'll shrink the balance sheet or tighten bank regulations.
And that would mean the end of the so-called Fed put. The idea that the central bank will always bail out the market.
That's the fear. And that perception alone is enough to steepen the yield curve and tighten financial conditions.
And that combination, higher long-term yields and tighter money, is basically rocket fuel for the dollar.
It is. And that's why this is a dollar story today, not an economic one. Money is flowing to the U.S. because of this potential policy shift.
Which brings us right to the carnage in commodities.
Yes, the great commodity unwind.
If you were holding metals yesterday, you were feeling pretty good, record highs, and then poof.
Unwind is being polite. It's a crash. We've seen gold lose the $5,000 handle.
Wow. 5,000 was such a huge psychological level.
It's massive. And look at silver. It's back below $100.
So it's wiped out the entire week's gains.
In a single session. And
Yeah.
copper is right there with them, dipping toward $13,100 a ton.
It was above 14,500 just yesterday.
Just hours ago.
Okay, so help us with the mechanics. Why does a stronger dollar cause such a fast, violent crash?
Well, the speed of it tells you one thing. Leverage.
Crowded trades.
Incredibly crowded trades. Everyone was on one side of the boat, borrowing money to get on a weaker dollar and more liquidity.
And then the margin calls came.
Exactly. The dollar spikes, the value of their metals drops, and the broker says, you need to post more cash or we're selling.
A forced liquidation.
And it cascades. When thousands of traders are forced to sell at the same time, the selling just feeds on itself.
It's a feedback loop.
A vicious one. It's not that the fundamental demand for copper wiring disappeared. It's that the financial logic propping up the price just evaporated.
So, we have the Fed drama, we have commodities crashing, and that brings us to the third pillar here, Trade Wars 2.0.
That's right. While everyone was watching the Fed, the White House was getting very aggressive on trade.
And this feels different. It's very targeted. We saw President Trump issue a warning to the UK.
And it's very dangerous for them to do business with China.
And then an even stronger warning for Canada. Even more dangerous, he said.
And he backed it up with a specific threat. A 50% tariff on all aircraft sold from Canada to the U.S.
50%. That's not a negotiating tactic. That's designed to shut down a supply chain.
It completely changes the game for cross-border manufacturing. But I think the bigger story is this new strategic toolkit they're building.
You're talking about the executive order on Cuba.
Exactly. They declared a national emergency and can now put tariffs on any country that provides oil to Cuba.
So it's using trade policy as a weapon for foreign policy goals.
It's blending sanctions, energy flows, and tariffs into one strategy. It makes the environment for multinational companies a complete nightmare.
Because a tariff could come out of nowhere,
Right.
based on something that has nothing to do with trade itself.
Right. And while the U.S. is doing this, look at what China announced today.
They're lowering tariffs on whiskey imports.
To 5%. It's a fascinating contrast, isn't it? Washington is waving a stick and Beijing is offering a little carrot. It makes China look like the reasonable actor here.
Which puts countries like the UK in a really tough spot.
A very tough spot.
Okay, let's pivot to geopolitics and energy.
Yeah.
We're getting some very mixed signals on Iran.
Mixed is the word for it. On one hand, President Trump says he wants to have talks with Tehran, hopes to avoid military force.
That sounds like de-escalation.
It does. But then, in the same breath, he mentions big, powerful ships moving toward the region.
So it's a bit of a carrot and a stick approach.
It is. But look at oil prices today. West Texas Intermediate is actually trading softer in the mid-63s.
That seems completely backward. Usually talk of warships in the Gulf sends oil soaring.
It goes back to the main character of the day, the strong U.S. dollar. It's acting like a heavy, wet blanket on the price.
So the Warsh trade is so powerful, it's actually neutralizing the war premium in oil.
It seems to be yes. The currency dynamic is overpowering the geopolitical risk. For now.
And meanwhile, the situation in Ukraine is still tense.
Very. President Zelensky said no territorial compromise has been reached, no official ceasefire, so that instability is still simmering.
And there was a report about an explosion at a refinery in Turkey.
Yes, details are still scarce. But in a market this nervous, any headline about energy infrastructure getting hit would normally cause a spike.
The fact that it hasn't today just proves how dominant the dollar is.
It's winning everything right now.
Okay, let's do a quick global roundup. The Japanese yen must be taking a beating.
It's getting crushed. It's a simple yield differential story. U.S. yields go up, Japanese yields stay at zero.
Money flows out of the yen.
Exactly. Plus, Tokyo's CPI data was soft, which gives the Bank of Japan no reason to tighten.
How about the euro?
It's drifting lower, but it's more resilient. This is a dollar strength story, not a euro weakness story. Eurozone GDP actually beat forecasts.
So the euro is just caught in the crossfire.
It is. But the real underperformer is the Aussie dollar.
I imagine so, with the commodity crash.
Absolutely. The Aussie is basically a proxy for metals. When gold and copper fall off a cliff, the Aussie goes with them.
And finally, equities. U.S. stock futures are slipping.
They are, and it's the small caps that are lagging the most.
Which makes sense. They're more sensitive to tighter financial conditions.
Exactly. They need to borrow money to grow, and that just got more uncertain. It hurts them way more than a cash-rich company like Apple.
So what's the big aha moment here? The main takeaway for today?
The takeaway is that the market has stopped trading on growth optimism.
Okay, so what is it trading on?
It's trading on Federal Reserve leadership risk. Headlines are setting prices, not economic data.
We've moved from a data-dependent market to a personnel-dependent market.
And that guarantees volatility. The fundamentals of the companies haven't changed, but the perception of the referee has.
A crucial point to end on. It's going to be a very interesting weekend.
Keep your eye on the dollar. It is the center of the universe right now.
Absolutely. That is it for today. Thanks for listening to the Financial Source Podcast. See you next time.